The financial world just witnessed something that hasn't happened in over 50 years. Gold, the ancient store of value that survived empires, currencies, and countless economic crises, just broke free from one of the most reliable relationships in modern finance. And if you understand what this means, you're about to see why the next 12 months could rewrite everything we thought we knew about wealth preservation. Let me paint you a picture of what just happened. For decades, gold and treasury yields moved in perfect opposition. When yields went up, gold went down. When yields fell, gold soared. It was as predictable as the sunrise. Traders built entire careers on this relationship. Algorithms were programmed around it. Central banks factored it into their reserve management. It was gospel, until now. In October, gold smashed through $4,000 per ounce for the 45th time this year. Let that sink in. 45 new all-time highs in a single year. But here's what should make your hair stand on end. Treasury yields didn't collapse. They didn't even budge significantly. Gold just stopped caring. This is what decoupling looks like. And it's not some minor technical glitch or temporary market anomaly. This is a fundamental shift in how the world's oldest form of money relates to the world's supposedly safest asset. And the implications are staggering. Think about what treasury yields represent. They're the baseline return for lending money to the United States government. When they're high, investors are demanding more compensation for that loan, usually because inflation is running hot, or because they're worried about default risk or currency devaluation. When they're low, it means investors are fleeing to safety, accepting minimal returns just to preserve capital. Gold traditionally moved opposite to this because of opportunity cost. When yields are high, holding gold means you're giving up that yield. Gold doesn't pay interest. It doesn't generate cash flow. It just sits there, being gold. So when you could get 5 or 6% risk-free from treasuries, gold looked less attractive. When yields crashed to near zero, suddenly gold's lack of yield didn't matter because you weren't giving up much anyway. But something changed, something profound. And to understand what, we need to look at who's buying gold and why. Central banks are accumulating gold at a pace we haven't seen since the early 1970s, right before Nixon closed the gold window and ended dollar convertibility. In the first 3 quarters of this year alone, central banks added over 800 tons to their reserves. That's not normal buying. That's panic buying dressed up in official statements about diversification and reserve management. But here's what they're not saying in those official statements. They're not saying they've lost faith in the dollar system. They're not saying they see the writing on the wall for U.S. fiscal dominance. They're not saying they're preparing for a world where the dollar isn't the unquestioned reserve currency, but their actions are screaming it. Look at China. They've been adding gold to their reserves every single month for over a year. Not occasionally, not when prices dip, every single month. That's not trading. That's strategic accumulation. That's building a war chest for a monetary system that doesn't exist yet, but that they're clearly preparing for. Russia took it even further. After the sanctions following the Ukraine conflict, they essentially said, fine, if you're going to weaponize the dollar, we'll just opt out of your system. They've been settling trade in rubles, yuan, and increasingly gold. They're not alone. The BRICS nations, representing nearly half the world's population, are actively working on alternative payment systems that bypass the dollar entirely. This isn't conspiracy theory. This is documented policy. These countries watched what happened when the U.S. froze Russian central bank reserves. They saw $300 billion become worthless overnight, not because Russia went bankrupt, but because the U.S. decided to flip a switch. And they thought, if they can do it to Russia, they can do it to us. So they're buying gold, physical gold, not paper claims, not ETF shares, not futures contracts, actual bars sitting in actual vaults, preferably in their own countries. Because gold can't be sanctioned. It can't be frozen. It can't be inflated away by a central bank printing press. It just is. And that's why gold stopped caring about treasury yields, because the buyers driving this market aren't making opportunity cost calculations. They're making survival calculations. They're not asking, can I get a better return elsewhere? They're asking, will my reserves still exist in 10 years? Now let's talk about what's happening in the physical market, because this is where things get really interesting. There's a growing disconnect between paper gold and physical gold. The COMEX, where gold futures trade, shows one price, but try to buy 1,000 ounces of physical gold for immediate delivery, and you'll often pay a premium, sometimes a significant premium. Why? Because there's way more paper gold than physical gold. The estimates vary, but some analysts suggest there are over 100 paper claims for every ounce of physical gold in the system. That works fine as long as everyone's content to trade paper. But the moment people start demanding physical delivery, the whole structure gets stressed. And increasingly, they are demanding delivery. Look at the Shanghai Gold Exchange. Physical delivery volumes have exploded. The premium for physical gold in Asia has been consistently higher than in the West. That's not supposed to happen in an efficient global market. Gold is gold, right? An ounce in New York should cost the same as an ounce in Shanghai, minus shipping and insurance. But it doesn't. Because Asian buyers, particularly Chinese buyers, want the real thing. They've seen too many paper promises evaporate. They remember when the London Bullion Market Association had to scramble to find physical gold during the pandemic. They remember when premiums spiked to $50 an ounce or more. They're not making that mistake again. This creates a fascinating dynamic. Western institutions are still largely trading paper. They're comfortable with ETFs and futures and allocated accounts. But Eastern buyers are draining physical supply. And at some point, those two worlds collide. At some point, someone holding a paper claim is going to demand delivery, and the vault is going to be empty. What happens then? Well, history gives us some clues. In 1980, gold hit $850 an ounce, which is over $3,000 in today's dollars. But that wasn't a smooth climb. It was a parabolic spike driven by a physical shortage. The Hunt brothers tried to corner the silver market, but gold got caught up in the frenzy. People were melting down jewelry, coin shops had lines around the block, and the price went vertical. We're seeing early signs of similar dynamics today. Not the same situation, obviously, but the same underlying tension between paper claims and physical reality. And when that tension breaks, prices don't move in orderly fashion. They gap, they spike, they leave people behind. Here's something most people don't realize. The gold market, for all its size and history, is actually pretty small compared to other financial markets. The entire above-ground gold supply is worth maybe $15 trillion. That sounds like a lot until you compare it to global stock markets at over $100 trillion, or bond markets at over $130 trillion, or real estate at over $300 trillion. So what happens if even a small percentage of that wealth decides it wants to be in gold? What if pension funds, currently holding maybe 1 or 2% in gold, decide they want 5%? What if sovereign wealth funds, sitting on trillions in dollar-denominated assets, decide to shift 10% into gold? The math gets scary fast, because there isn't enough gold to absorb that demand at current prices, not even close. Prices would have to rise dramatically to ration the available supply. Some analysts are throwing around numbers like $7,000, $10,000, even $15,000 per ounce. And while those sound crazy today, they're not crazy if you understand the supply-demand dynamics. Gold production is basically flat. Mines take years to develop. The easy gold has been found. What's left is deeper, lower grade, more expensive to extract. Meanwhile, demand is accelerating, not just from central banks and Asian buyers, but from a growing recognition in the West that something is fundamentally broken in the financial system. People see inflation eating their purchasing power. They see their savings accounts paying 2%, while real inflation runs at 7 or 8%. They see stock markets at nosebleed valuations propped up by central bank intervention. They see government debt spiraling into territory that can never be repaid in real terms. And they're starting to ask uncomfortable questions. Questions like, what happens when the bond market finally cracks? Because it will crack. It has to. You can't run trillion-dollar deficits forever. You can't keep interest payments manageable when your debt is $35 trillion and rising. At some point, the market demands higher yields to compensate for the risk. And when yields spike, everything breaks. We almost saw it happen in 2022. The Fed raised rates aggressively to fight inflation, and suddenly banks were sitting on massive, unrealized losses in their bond portfolios. Silicon Valley Bank went under. First Republic collapsed. Credit Suisse had to be rescued. And the Fed blinked. They opened emergency lending facilities. They backstopped the system. They proved once again that they'll do whatever it takes to prevent a deflationary collapse. But here's the thing. Every time they do that, they undermine confidence in the currency. Every bailout, every intervention, every time they choose inflation over deflation, they're telling the world that dollars will be worth less tomorrow than they are today. And smart money is listening. That's why gold decoupled from yields. Because the old relationship assumed the dollar system was stable. It assumed treasury bonds were truly risk-free. It assumed the Fed could manage the economy without destroying the currency. Those assumptions are dying, and gold is pricing in a world where they're dead. Now, if you're sitting on retirement savings, this should concern you, because most retirement accounts are built on those same assumptions. Stocks and bonds. 60-40 portfolios. The idea that over the long term, markets go up and bonds provide stability. But what if bonds aren't stable? What if the correlation between stocks and bonds breaks down, like it did in 2022 when both fell together? Quick aside here. If you've got 100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. Covers how to get physical gold into your retirement account without triggering taxes or penalties. Worth checking out if you're thinking about this stuff. No pressure, just information. Anyway, back to what's happening in the market, because the decoupling isn't just about gold and yields. It's about gold and everything. Gold is starting to move independently of all the traditional correlations. It's not just an inflation hedge anymore. It's not just a safe haven. It's becoming something else. A parallel currency. A vote of no confidence in the existing system. Look at what happened during the banking crisis last year. Gold spiked while stocks fell. That's normal safe haven behavior. But then stocks recovered, and gold didn't give back its gains. It just consolidated and then pushed higher. That's not normal. Normally, when the crisis passes, gold retreats. But this time, it acted like the crisis never ended. Like the underlying problems weren't solved, just papered over. And that's exactly what happened. The problems weren't solved. Banks are still sitting on unrealized losses. Commercial real estate is still imploding. Regional banks are still struggling. The Fed just stopped talking about it and hoped everyone would forget. But gold didn't forget. Here's another piece of the puzzle. The dollar itself is under pressure in ways that aren't showing up in the dollar index. That index measures the dollar against a basket of other currencies, mostly euros and yen. But what if those currencies are also losing value? What if it's a race to the bottom, and the dollar is just losing slower than the others? That's where gold comes in. Gold doesn't care about relative currency values. It measures absolute purchasing power. And by that measure, every major currency is losing ground. The dollar, the euro, the yen, the pound. They're all being debased. They're all being printed into oblivion to fund government spending and bail out financial systems. Gold is the canary in the coal mine. It's telling us that the entire fiat currency system is in trouble, not just the dollar. The whole concept of government-issued, debt-backed money that can be created at will. That's what's breaking down. And gold is the alternative that's been waiting in the wings for 5,000 years. Think about the historical parallels. In 1971, Nixon closed the gold window because the U.S. couldn't maintain the fiction that dollars were as good as gold. Too many dollars had been printed to fund the Vietnam War and Great Society programs. Foreign central banks were demanding gold, and Fort Knox was running low. So Nixon said, "No more gold convertibility. Dollars are now backed by the full faith and credit of the U.S. government." And for 50 years, that worked. The dollar remained the reserve currency. Oil was priced in dollars. International trade was conducted in dollars. The U.S. could run deficits without consequence because the world needed dollars. It was an exorbitant privilege, as the French called it. But privileges don't last forever. And the signs are everywhere that this one is ending. The petrodollar system is cracking. Saudi Arabia is accepting yuan for oil. Russia and China are settling trade in their own currencies. The BRICS are developing alternative payment systems. De-dollarization isn't a future threat. It's happening right now. And as the dollar loses its privileged position, the U.S. loses its ability to run unlimited deficits. We lose the ability to export our inflation to the rest of the world. We lose the ability to fund our government by printing money and having foreigners absorb the consequences. And when that happens, the chickens come home to roost. That's the real reason gold is decoupling. It's not about yields or inflation or any single factor. It's about a fundamental shift in the global monetary order. It's about the end of an era. And gold is pricing in what comes next. Now, what does come next? That's the trillion-dollar question, or maybe the $4,000 per ounce question. Because the answer determines whether gold goes to 5,000, 7,000, or some number that sounds insane today but won't sound insane when we get there. Here's what we know. The fiscal situation is unsustainable. The U.S. is running deficits of $2 trillion a year with no end in sight. Interest on the debt is approaching $1 trillion annually. That's more than we spend on defense. And it's only going to get worse as rates stay elevated and more debt rolls over at higher rates. The political will to fix this doesn't exist. Neither party is serious about cutting spending. Neither party wants to raise taxes enough to close the gap. So the deficit persists, the debt grows, and eventually The only way out is inflation. Not the kind of inflation we saw in 2022. The kind of inflation that destroys currencies. The kind that sends people scrambling for anything real, anything tangible, anything that can't be printed. Gold thrives in that environment. Not because it goes up in real terms, but because everything else goes down. Your dollars buy less. Your bonds pay back in devalued currency. Your stocks get crushed by the economic chaos. But gold maintains its purchasing power. An ounce of gold buys roughly the same amount of goods and services it did 100 years ago. That's not an investment return. That's insurance. And that's what people are starting to understand. Gold isn't about getting rich. It's about not getting poor. It's about preserving what you have when everything else is being systematically devalued. It's about having something that will still have value on the other side of whatever's coming. The institutions get this. That's why central banks are buying. That's why sovereign wealth funds are accumulating. That's why family offices are allocating more to physical precious metals. They're not trying to time the market or catch the next rally. They're building positions for the long term. They're preparing for a world that looks very different from the one we've known. And here's the thing about gold. Once it starts moving, it tends to move fast. The rally from 2000 to 4000 happened in less than 5 years. The rally from 300 to 1900 in the 2000s took about a decade, but had periods of explosive growth. When gold catches a bid, when the momentum builds, when the narrative shifts from barbarous relic to essential holding, prices can move in ways that shock people. We might be at the beginning of one of those moves right now. The decoupling from yields is the signal. It's telling us that the old rules don't apply anymore, that the old correlations are breaking down, that we're entering a new phase where gold isn't just reacting to other markets but leading them. Think about what $4,000 gold means. It means the market is pricing in serious monetary instability. It means investors are willing to pay a premium for safety and certainty. It means the confidence in fiat currencies is eroding faster than most people realize. And if we're at 4,000 now, with the system still functioning, with banks still operating, with governments still paying their bills, what happens when things actually break? That's the question keeping central bankers up at night. Because they know the math doesn't work. They know the debt can't be repaid. They know the promises made to retirees and government workers and bondholders can't all be kept. Something has to give. And when it does, gold will be there, doing what it's always done, preserving wealth through the chaos. The decoupling we're seeing isn't a bug. It's a feature. It's gold asserting its independence from a financial system that's increasingly divorced from reality. It's gold saying, I don't care what your yields are. I don't care what your stock market is doing. I don't care about your economic theories or your central bank policies. I'm gold. I've survived every empire, every currency, every crisis, and I'll survive this one too. And that's why smart money is paying attention. That's why the accumulation continues even at these prices. Because they understand that 4,000 might look expensive today, but it might look cheap in hindsight. Just like 2,000 looked expensive when gold was at 1,500. Just like 1,000 looked expensive when gold was at 300. The trend is your friend until it's not. But in gold's case, the trend has been up for over 2 decades with only brief interruptions. And every interruption has been followed by new highs. Every correction has been bought. Every dip has been accumulated. Because the underlying drivers, the fiscal insanity, the monetary debasement, the geopolitical instability, they're not going away. They're getting worse. So when you see headlines about gold decoupling from yields, understand what that really means. It means the market is telling us something profound. It's telling us that the old world is ending and a new one is beginning. It's telling us that the assumptions we've built our financial lives on might not hold. It's telling us that maybe, just maybe, the ancient wisdom about gold being real money wasn't so ancient or so foolish after all. The price of gold is about to decouple not just from yields, but from everything we thought we knew about how markets work. And if you're not prepared for that, if you're still thinking in terms of the old correlations and the old relationships, you're going to be caught off guard when the next phase begins. Because it's not a matter of if anymore. It's a matter of when. And based on what we're seeing, when might be sooner than anyone expects.